This fund, managed by Ivan Bouillot for more than 15 years now, applies BLI's business-like investment methodology that focuses on the generation of attractive long-term risk-adjusted returns. The strategy is benchmark agnostic, conviction-based, and aims to invest in high-quality companies that benefit from solid competitive advantages, strong capacity of free cash flow generation, and good ESG profile. The fund is classified as Article 8 of the SFDR regulation and benefits from the French label ISR since end of 2020. Before we begin, a few words about Banque de Luxembourg Investments. BLI is the asset management company of Banque de Luxembourg. We manage almost 16 billion euros through four main asset classes: equities, bonds, diversified management, and funds of funds. Our investment approach is based on active and conviction-based management. You can ask questions during the presentation using the question and answer system of WebEx. We will answer them at the end of the webinar. A summary of the conference will be made available in the next few days in English as well as in French, alongside with the video replay. And now, I leave the floor to Ivan Bouillot, the fund manager of BL-Equities Europe, who will give you an update on his strategy and the portfolio. Ivan?
Yes, thank you, Françoise. Good morning, everyone, and thank you for joining our BL-Equities Europe strategy update call on year-to-date performance. As Françoise mentioned, please feel free to ask any question at the end of the call or reach out to us for more detailed information you might be interested in. So I will first quickly recap the portfolio investment approach for new joiners. So BL-Equities Europe is managed with a bottom-up conviction-based approach, agnostic of benchmarks and short-term market movements. The portfolio has a conservative growth profile. The process focuses with a mid to long-term mindset on quality and valuation criteria. Quality is referred to high and sustainable return on invested capital through disciplined capital allocation by companies while maintaining a quality balance sheet and an attractive ESG profile. Rewarding valuation, we focus on expected return over a 3 to 5 years investment horizon, leading to protecting the downside when valuations are high and hence giving up some of the relative return with expectations to overcome the difference when markets weaken. The portfolio will have on average 30 to 35 positions, with some sectors structurally not represented in the portfolio, like financials, automotives, or utilities. As Françoise mentioned, BL-Equities Europe process has fully integrated an ESG methodology, as it is an Article 8 fund, which has also the French RSI label. The universe of the portfolio is reduced by 20% according to different ESG metrics, sector exclusions, and severe ESG controversies. Through our ESG methodology, we monitor and engage with companies on several ESG considerations related to SDGs and to internal ESG practices. We also clearly target to invest in companies who outperform peers on their CO2 emissions and in relation to social controversies. This process is complemented by an active ESG policy and the inclusion of an ESG risk premium or discount in our company valuation models. So let's jump now into our performance figures. The first quarter of the year was not favorable to financial markets, with the leading equity market indices falling by 5 to 10% and the global government bond index by around 6% on a global basis. Markets have been driven lower by the significant increase in inflation, which led to a change in the central bank's attitudes. The conflict in Ukraine was the second main factor behind these declines. At the regional level, the US market, of course, held up much better than its European counterparts, benefiting from its safe haven status and the fact that the US economy is less impacted by the war in Ukraine. During the quarter, BL-Equities Europe underperformed the market by 7%. We closed the quarter with a 12.4% decline in net asset value versus a decline of 5.3% for the MSCI Europe. The portfolio disconnect with the market was particularly strong and fast during the first 3 trading weeks of the year, with a correction in growth and quality stocks, as we can see in this chart. This correction was correlated to the increase in inflation and interest rates, as quality and growth sectors were trading at valuations much higher than historical average. We view this correction as a needed and healthy movement to bring valuation of quality and growth stocks to more normal levels. The value style, however, was able to outperform in this environment, as we see in this chart through the green line. The MSCI Europe value has indeed remained in positive territory almost a full quarter, with albeit a correction at the beginning of the conflict in Ukraine. And as a reminder, we almost have no investment in the value style, as our process translates in having very few, if any, investment candidates in the financial, energy, or automotive sectors. And so we see here the big gap which the portfolio suffered at the beginning of January, the portfolio being represented with the white line, while the MSCI Europe is represented here on the chart through the orange line. In terms of portfolio attribution, we have a positive impact from our exposure to cyclical sectors like chemicals and consumer discretionary. On the opposite, not having had investments in energy and banks was a negative. The market rotation, especially out of the technology and out of the industrial sectors, had also a negative impact on the portfolio. Stock picking contributed negatively to the relative performance of the portfolio over the quarter. The contraction in valuation multiples in the technology and industrial sector was indeed quite significant for our holdings, with stock prices falling by up to 20%. The main positive contributors to the portfolio performance were either defensive investments, which have also benefited from favorable specific catalysts like Novo Nordisk, Christian Hansen, Air Liquide, Nestlé, or Experian, with positive business momentum. But the portfolio has also benefited from companies who might benefit from the end of the COVID crisis and its implications, like Amadeus, with a potential recovery in business and leisure travels, but also Grifols, one of the global healthcare leader in the plasma market, with a much needed improvement in blood collection to produce the plasma derivatives in case restrictions are lifted. The main detractors to the performance year to date were essentially large holdings of the portfolio, who enjoyed a strong 2021 performance, but which reversed in January. These movements were essentially linked to a mean reversion of their market valuation. Indeed, fundamentally, they remain very solid, with positive earnings releases and favorable business outlook. The main exception to this is maybe Geberit, the Swiss sanitary technology company, whose business might be facing a slowdown due to the relative weakness of the construction market in Germany, one of the biggest markets of the company. Regarding to portfolio management, we have emphasized investments in companies with strong pricing power, who should be able to pass on higher input costs to clients in order to protect margins. We have also increased exposure to more defensive names like Nestlé and Experian, two new holdings, by the way, but also increased exposure to Roche, Reckitt Benckiser, or Unilever. Also, on price weaknesses, we have increased holdings in Legrand, Netcompany, and Teleperformance, given the bright medium-term prospects. On the sell side, we have sold our position in Essity, the Swedish hygiene and health company, due to uncertain margin developments, and we have reduced also our exposure to some highly valued companies like Dassault Systèmes, Spirax-Sarco, Essilor-Luxottica, or Christian Hansen. We also started to reduce our position in Boozt, the Swedish online fashion retailer, following an expected contraction of of their margins and return on invested capital. At the time being, the portfolio has 36 holdings, with top 10 holdings accounting for 47% of the assets under management. The growth pocket of the portfolio accounts for 40% of the allocation, while the more defensive names account for 50% of the portfolio. As can be seen on the slide, we have kept a high allocation in cash during the whole quarter, which now amounts to almost 9%. It is for one reason to counterbalance at the margin the valuation of the portfolio, which is higher than the market, but also to be able to profit from market volatility to eventually increase holding or add new companies in the portfolio. In terms of the biggest holdings in the portfolio, there are no big changes versus 2021, with the exception of the appearance of Reckitt Benckiser and Nestlé to increase the defensive pockets of the portfolio. Here, we summarize the holdings of the portfolio according to the four main styles we have: growth investments in Sika, L'Oréal, Halma, or Spirax-Sarco, technology exposure through Teleperformance, Reply, Netcompany, Dassault Systèmes, some defensive names, SGS, Grifols, Sweco, Novozymes, or Essilor, but also an exposure to cyclical companies, Amadeus, Legrand, Assa Abloy. But as can be seen, we are lacking investment exposure to deep cyclicals or more lower quality cyclical names, which have driven the market higher since the beginning of the year. On this page, we see some mix of the portfolio with also the allocation according to market capitalization. Allocation towards market capitalization is still as it used to be. We have a slightly lower exposure to really the big market capitalization versus the index, I mean about 50 billion, and a higher exposure towards the mid-large names. The portfolio metrics continue to show a higher valuation than the markets, PE of 25 for 22 PE for 2023, which is higher than the markets. Quality metrics, of course, are higher also, given the high competitive advantages that we look for in our companies, with a return on equity of 23% versus 40% for the market. In terms of expected earnings growth, I mean, we managed nevertheless to have a decent earnings expected growth for 2022 of 13% versus 19% for the markets. Of course, we are less exposed to companies who benefit from a significant market economic recovery or increased interest rates, like maybe deep cyclical companies, automotive, or the financial sector. However, on 2023, following a normalization of the recovery in earnings for 2022, we see that our portfolio is still expected to show a higher earnings growth than the market, with 12.6% versus 6% for the Stoxx 600. In terms of country allocation, which is absolutely the result of the pure individual bottom-up opportunities. We see higher exposure to France or Denmark than the market. France, it is more linked to opportunities we found in France, in the French market over the last 2 years, like L'Oréal, Teleperformance, or Dassault Systèmes. In Denmark, we see also an exposure of 11% versus 4% for the market. It's essentially linked to a big holdings in Novo Nordisk, Christian Hansen, and Novozymes, which is a defensive pocket of the portfolio. We have a lower exposure to the UK, which was linked to the Brexit, and less opportunities that we found on a relative basis within our universe. In terms of sector allocation, we see quite balanced allocation towards still cyclicals and more defensive names. A big exposure to materials, but as a reminder, this remains specialty chemical companies, so no real pure exposure to commodity names. We still have a nice exposure to industrials, quality industrials like for example, Assa Abloy and Legrand. This is counterbalanced by more defensive exposure in healthcare and consumer staple names. So to conclude, the environment for financial markets have clearly deteriorated in recent months, despite economic figures and companies' earnings releases, which remain strong, but signs of weaknesses have clearly appeared over the quarter. The invasion of Ukraine and the sanctions against Russia have also increased upward pressure on commodity prices. And all things being equal, we think if inflation is in the end, which was not expected last year, it is in the end set to remain higher for longer. At the same time, high energy prices and food prices will have a negative impact on disposable household incomes and business production costs. This is likely to weigh on private consumption and investments going forward in 2022, and hence on growth overall. So this puts the central banks in something of a quandary. High inflation calls for a significant tightening of their monetary policies, while high level of debt and the risk of a significant economic slowdown are likely to dampen their resolve. In the short term, as if monetary authorities have changed their attitudes and are currently considering aggressive monetary tightening. In a context of high inflation and rising interest rates, we think value stocks can continue to outperform, as the trend of valuation multiples normalization should persist. So in this environment, we will continue to remain on the conservative side as much as we can within our universe, favoring companies with strong pricing power, companies facing less business disruption from supply chain issues and Ukraine conflicts, and companies with specific catalysts to unlock value. So this finalizes the short update on the portfolio. I'm ready to take on any questions if you would like to address them now, or eventually reach out to us for a dedicated call.
Thank you, Ivan. Thank you for this presentation, which was very clear. At the moment, we do not have any questions. As Ivan just said, do not hesitate to reach us or your sales representative at Credit Mutuel Investment Managers. In case you have any questions, they will be happy to send it to us so we can answer them as soon as possible. If we do not have any questions now, I think we can close this webinar. Again, I would like to thank you all for attending this presentation. Again, thank you, Ivan, for taking the time to explain your strategy to us. And I wish you all a nice end of the week. And thanks again.
Thank you. Goodbye.
Bye.